single contract. Now, there's a couple observations that we can make about selling out of the money puts in this case. Number one is that we didn't hold it until July 7th. So we profited about a week earlier and took our profits a week earlier than the trade that we would have made by buying calls. In addition, the profit potential is really diminished, but in addition, the total dollar profit for the trade is about 1/10 of the size of the in-the-money call options that we purchased. So the profit potential was limited because we sold the option for 52.5 cents, and that's the most we could have made from that trade. Whereas an in-the-money call option that we purchased, not only does it have less risk because we can only lose the amount of premium that we paid for that option, but it also had unlimited profit potential if the market continued to go higher. So you really have to decide whether or not selling out of the money options is a good idea and appropriate for your portfolio. Obviously, in this case, if we were absolutely sure we were going to have a significant rally, buying an in-the-money option, call option, was the best route to take for pure dollar gains. The second choice would be an at-the-money option if we thought a strong rally was coming. But again, the in-the-money option gave us the opportunity to profit and lose only a little bit of money. Even if we were wrong by the market going sideways or up just slightly, we could have made a small profit. The fact that it roared very much higher, rallied very strongly, gave us a very good return on our money for the time that we had it in the trade. I know it's very popular for a lot of people to sell options these days because they think they're gaining the income advantage. However, in future videos, we're going to be talking about technical analysis, and you'll have a very good idea of the direction, the potential direction for a market to take over a short period of time, from a few days up to maybe a couple of weeks, that will give you a better opportunity to profit from in-the-money options. Now, you could have also purchased, like I said, we purchased an in-the-money put option, and we did have a loss, but it was fairly insignificant. It was a fairly small loss compared to the profit that we had on the gain from the call option. Now, finally, I'll conclude this video with a bit of an advanced strategy. We saw that if we purchased an in-the-money call option, if we thought a big move was coming. Now, this is only in case you think a big move is coming. You believe that it's going to be to the upside based on the analysis that you've done, but you're not really sure. It could also go down. In fact, there could have been a crash. There could have been, something, a major event in which you think the market could have as well gone down, but a big move is coming. Now, if that's the case, what you can do is purchase an in-the-money call option, the same one that we purchased before. We want to purchase an in-the-money call option with a delta of between 88 and 94. So in this case, we're going to go with a 48 strike price. And then you could also purchase an at-the-money put option. You buy an at-the-money put option to protect you in case the market decides to drop dramatically. Now, this type of strategy only works if you think a very large move is coming and you're not exactly sure which way it's going to go. You're going to play it so you believe that it's going to go higher, the market is going to rally higher, and then you use the put as protection. Now, the important thing to keep in mind about this strategy is the market does have to move, and it has to move fairly quickly, or the time value of your put option is going to be eroding your profits. So if we go directly to our end date, of July 7th, you can see that we had the $509 gain on the July 48 call option, which was in the money, and we lost the at-the-money put option, the 54 put option, which was at the money of $131. That still gives you a gain of over $370 on the position, which is slightly better than the at-the-money call option alone that we had. In addition, you had an unlimited profit potential if the market did decide to sink dramatically and sell off in a very, very large way. So that's a potential strategy that you could keep a look at if you only if you think a very large move is coming, and it's coming very, very soon. In the next video, we're going to be talking about technical analysis. And it's so important to understand where people are buying stocks and where they are selling stocks so that we have the advantage of determining when to put our purchase orders in for option trades. Remember, our two primary considerations in trading are preservation of capital and then waiting for a setup. It doesn't have to be perfect all of the time. It certainly does have to be well thought out, though. And we're going to be talking about that in the very next video.